Hey everyone, Jerry Massasak here, an advisor, tax strategist with W.A. Smith Financial. Recently came across an interesting article in Kiplinger that dealt with non-taxable income sources. I'd like to maybe share some benefits with you, how that could fit in and be part of your financial plan. And in my 30 years, the number one question I get on one of these non-taxable sources. And before I get into that, though, if you would be so kind to hit the subscribe button, and it's going to help us reach a lot more people like you that are looking for this kind of help. So the article is titled Types of Non-Taxable Income. And again, it was published in Kiplinger.com. I know a lot of people think, how many sources, how many types of non-taxable income are there? And there's actually quite a few. So bear with me here as I kind of go through them, and I'm going to highlight some that I think are super important and really beneficial to you and could be useful for you. They talk about gifts and inheritances, and I'm going to come back to that at the very end because I'm going to spill the beans a little here. That's really the question I get the most often. It's got a little bit of complexity to it. Roth IRAs, I will tell you, Roth IRAs are such a strong component and such a great opportunity within somebody's plan in terms of how they can control their taxable income. Strategies behind how to either convert or when to contribute, because you can contribute to an IRA, a Roth IRA, or you can maybe contribute in an employer 401k plan. So super powerful, non-taxable income source. Another thing that is a non-taxable source is life insurance proceeds. So most of the time, again, within the code, there's always little exceptions here and there, but most of the time, life insurance proceeds are a tax-free source. How would this come into play? You know, if you've got a bucket of money and those dollars have a purpose behind them, and you've got this bucket sitting off to the side that may not have that purpose of income or be part of your portfolio necessarily, maybe life insurance is an opportunity on a legacy plan standpoint that you can utilize and pass more than what you would have normally passed using life insurance as a component of your overall wealth plan. I think it's very overlooked. It's a tool that's used by the ultra wealthy quite often in order to pass income from one generation to the next in a very, very tax efficient manner. Long-term care insurance, used in the right way, that income that's coming out of a long-term care policy, that's tax-free also. A lot of people think, hey, I'm pulling money out. There's a tax component. Not with long-term care insurance. Used for long-term care facilities and care, tax-free. Non-taxable source of income. As I dive in a little deeper into this article, you got muni bond interest. Municipal bond interest is interesting because it is non-taxable for the most part on the federal side. Depending on what state you live in, there could be a state component of taxability. So you want to be super careful. Maybe you want to use this as your income plan. Maybe this is a reduced risk portion of your wealth plan, wealth strategy, your investment strategy, so to speak. You know, purpose is so important within somebody's wealth strategy planning and knowing why you're doing something. You need to make sure that you're talking to your trusted advisors to help you along the way and whether or not this makes sense, but it is a great tax-free source of income. Capital gains. You say, how could that be? How could that be a tax or a non-tax source of income? If you're in the 12% bracket, you have the opportunity to realize long-term capital gains and pay no taxes at all on them. So this strategy can be employed maybe with a charitable giving strategy as well. So this would be a way where you can really piggyback a bunch of different things together. But if you think about charitable giving, and if you are on the charitable giving side of things, there's a lot of opportunity in the code. Something called a donor advised fund that allows you to give appreciated property, get a greater tax deduction for that appreciated value. And maybe that can drive you into the 0% tax bracket. So there would be the 12% tax bracket and the 0% long-term capital gain opportunity that exists. Alimony, those of you receiving alimony, again, this is one of those tax-free things, and it used to be taxable. So it's no longer a taxable item. It's no longer a tax deduction either for anybody that's paying alimony, but those receiving it, and child support for that matter, and disability type benefits. Those are some other sources that are part of this article. But the number one question that I get, that I've gotten through my career, deals a lot with the gift and inheritance piece of this article and the non-taxable portion and how that works. Gifting. Most people are aware there's an annual limit of, and it's indexed for inflation. Currently, it's $18,000 that somebody can give somebody. There's no reporting. There's no tax. Pretty simple. What a lot of people don't know is you can actually give more than that away to an individual without a tax impact. But what you're doing there is you're going to have to file a tax return so the IRS knows about it, and you're going to use part of your gift and estate exclusion or exemption amount. So currently that amount is $13.6 million. That's for a single person. If it's a joint, it's double that. So there's quite a bit of bandwidth within this gifting strategy in relation to, and a lot of times this is used on the estate side of things or the legacy side of things, moving assets out of your estate into somebody else's hands. And this has to do with inheritance tax, not income tax. All right. Now, inheritance. Most people say, okay, and this article alludes to it. Hey, if you're getting cash or property, there's no taxes attached to it. It's a non-taxable event, which on the surface, I'd say, okay, maybe correct. The property side, you get a step up in basis, and that allows you to revalue the asset at the greater value, which maybe creates a non-taxable event. But there's something else that people inherit, and as a beneficiary, and it's an IRA. And it could be Roth, or it could be a traditional. Traditional IRA, that will have a tax component to it. You inherit it as the beneficiary, and you're not the spouse, you're going to pay taxes. You got 10 years to exhaust that value. And within that 10 years, when you're taking money out of that IRA, taxable event. So you will be paying taxes on that. So an inheritance isn't always a tax-free deal. And on the Roth side of things, this is something that I see people stumble on an awful lot. There's a rule with the Roth, and this holds true with an inherited Roth IRA as well. So it's both. It's if it's your Roth IRA or it's an inherited IRA, it's got to be around for 5 years. So if it's not around for 5 years, the income, the growth attached to that Roth is taxable. So what does that mean? Put $10,000 into a Roth IRA, it grows to $20,000. You inherit that. It's only been around for 2 years. You say, hey, it's a Roth, I'm taking the money out. Well, guess what? That extra $10,000, that growth, that's a taxable event. Not subject to penalty, but it will be subject to income taxes. So you're going to want to make sure that when you're inheriting these types of dollars, that you're working with somebody that you can trust on your financial advisory team that knows how all this will get incorporated and how this should be strategically pulled out, because there are ways to utilize the tax brackets when you're talking about inherited money. All right. So that is the number one question. Hey, I'm getting this money. How's this going to be taxed? And it's one of my sayings is it depends, and really it depends. So if you're currently taking advantage of some of these non-taxed income sources and you don't know if it's maybe working for you as well as it could be working for you, click on the link below, share it in the comments, and don't forget, share, like, and subscribe, and we'll see you next time.